Just for fun, for the last few minutes, I'm going to take you through something that you don't want to go through. I mean, you're really going to be unhappy about this, but we're going to talk about Circular 230. I know, please, Jonathan, I can't stand it. It hurts my head. Now, everybody in this room knows about Circular 230, even non-lawyers like Laird, because Laird, I don't know if it's the bottom of your email, but every email you get from some professional is going to have the Circular 230 disclaimer. Nothing contained in this message, it's a recipe, for example. Nothing contained in this message can be used by anybody for purposes of protecting you from tax penalties. So I'm going to take you through a little whirlwind of it. I'm going to point out one thing that's been there for quite some time, and then I'm going to take something that Ms. Zadel is going to be very squirmy about, and everybody else here who is a manager of his or her law firm, who's the head of the Trust and Estates Department, either at your office or firm Y, or the head of the tax department, or you're on the management committee of the firm, you're in deep tapioca today. You're in deep tapioca today. Now, the IRS doesn't want you to plan, and they have penalties. And by the way, you need to know what those penalties are, and nobody here knows they are. And I'm not talking down to you. The only reason I know about this is because my best lawyer friend, Mitch Gans, and I write the only book on Circular 230, which is published by the Practicing Law Institute. By the way, I want to tell you, that book, the Circular 230 desk book, is the most thoughtful holiday gift you can give anyone. It's true! It's true! Now, they did a lot of stuff here, but we're going to go down here and we're going to do it. But I want to tell you, there are affirmative duties under the circular and prohibited actions. By the way, you still have to comply with your state ethical rules, but if you do any tax work, you give advice, you prepare returns, you do wills, anything to do with taxes at all, even if you're not jumping in front of the IRS, it's quite clear you are covered by the circular. And these are ethical rules you need to know. And I'm not going to ask anybody how many of you have read the circular. I know nobody in this room has other than me, and I did it because I read a book on it. But you need to, because someday, sometime, if the IRS comes in and they're going to ask you, have you read the circular? Remember, the lie is always worse than the act. You ought to do it. And in fact, you are going to do it because otherwise you're going to be in very, very deep tapioca. There are affirmative duties and prohibited actions and enforcement methods which include disbarment. Affirmative duties include submitting records and information to the IRS when it asks for it promptly. Now, I can't tell you what promptly means, but you can't intentionally delay or say, you know, you and the horse you came in on. The other thing is you have to promptly dispose of any IRS matter. So if you say, well, look, here's the deal. We got 9 months to go till the statute of limitations runs. Let's just delay. And maybe they'll forget about it. It's possible you are violating the circular. So you better gin up something that the reason for the delay is not you're trying to do it. Here's a contemptuous behavior, section 1051. If you threaten someone who works for the IRS, you're in violation. Now, it doesn't mean I'm going to kill you, I'm going to, kidnap your kids. It may include, I'm going to talk to your supervisor. I'm going to write the commissioner about your attitude. A threat, and again, it's not defined as to how broad or narrow in scope it is, but I would be very, very hesitant to threaten somebody. If you want to mention, by the way, I disagree with this, and I think that other people in the IRS ought to know about your position. I don't think that's a threat. I think it's the way it is just to make a statement, but think about it carefully. Abusive language. Abusive language to an IRS person. In fact, I don't even use the words hell or damn, and I'm not kidding, when I talk to people from the IRS unless I know them very well or they start it. I know some guys and gals now in the IRS, and if, they use at least they use the words hell and damn, and sometimes, I know this is scary, but sometimes things even a little stronger, but I would be very careful about it. Now, making false accusations or statements is bad, but even circulating malicious matter about an IRS personnel is something. So if I post something on the Access listserv and I said, has anybody here ever dealt with appeals officer John Smith? And somebody on the listserv comes back and says, and calls me and says, that guy is the biggest son of a bitch in the world. You can't believe how stupid he is and stuff. Now, it may be true, but it's malicious. That person could be subject to discipline. One of the things I would do, don't put it in writing. And remember, emails are forever. Now these, you know, you can just say this is, you know, it's part of life, but you've got to be a little careful because you know the IRS is not your friends. Now, the good news is that the violation of Circular 230 in almost all cases is willful, or if it relates to advice, sections 1034 through 1037, it's willful or reckless or gross incompetence. So if it's a one-time deal, unless it's willful or reckless, you don't have to worry about it. If there's a pattern, you're going to be caught. So you've got to be careful, and let's take a look at some of these things. These 4 sections tell you you have to follow special rules in giving advice. Now, advice isn't defined, but if someone says to you, is alimony deductible under the Internal Revenue Code, and you say, yeah, section 215 says alimony paid is deductible, you're not giving advice. And by the way, this is very important to realize, is that you don't need a professional or attorney-client privilege in giving that advice. So if somebody comes up to me after this lecture and asks me a question and I tell you what I think the rules are, I got no attorney-client privilege with you. I'm not even licensed to practice law anymore. I've let my stuff go into hibernation, and yet I'm still covered by the circular because the services rule is once you're under the circular, you are under the circular forever. You can never get out. So as a consequence, when you're even talking to someone, no attorney-client privilege, no professional relationship, it's not one of your colleagues, it still could be advice under the circular. You don't even have to anticipate that people will rely on it. Well, I didn't know she was going to rely on this. She just called me and asked me a question. You don't need that, and you still are under advice. And one question is, if you say, by the way, this is not tax or legal advice, is that sufficient? Anybody here work for a bank or trust company? Again, you don't have to be embarrassed. You've got it on your stuff. U.S. Trust, J.P. Morgan, Sunbank, everybody has it. You know, we do not give legal advice. We don't give tax advice. You can say it, but is it sufficient when you've told them all about Gratz or Cupert's or whatever's going on? Nobody knows the answer to that. So I worry sometimes a little bit about it. Or when law firms send around flyers, you know, your law firm, I don't know, does your law firm send notices to clients? Diana? Sure. And you can say that we know this isn't tax advice, you can't rely on it, but it still may be advice as a practical matter. Now, 1034 is a very scary section. And within the next month, you will have a department meeting about Section 1034. I guarantee you're going to have it. And what you're going to do is you're going to go through this and you're going to make everybody very scared and very uncomfortable because it applies whether it's oral or written advice. It applies whether it's before the transaction, like you're telling somebody how a GRAT works or how a Cupert works or how an installment sale works or how the supercharged credit shelter trust works, or after the fact. And it's before the filing the return and after filing the return. It is exceptionally broad in scope, and you have 3 duties. Number 1, you cannot sign a return or advise about a return that doesn't constitute a reasonable position. Now, whether or not it's reasonable isn't what you think. It isn't what your partners think. It isn't what your colleagues at another firm think. It's an objective matter as whether that gray-haired judge, when you come before her, decides whether or not the position on the return was reasonable or not. What is reasonable? Nobody knows. Mitch and I found something that would indicate if there's 1 chance in 10 that it is correct, then it is a reasonable position. But how do you determine whether or not it's 1/10 in 10 or lower than that or higher than that? The one thing I'm telling you you have to do is to make a record of how you came to the conclusion that it was reasonable. The second thing is that you can't accept information at face value. If your client tells you something and in the light of day or at a later time it looks like it wasn't reasonable, Diana, for example, had a client who was 94, and he had someone he wanted to make a gift to, and Diana met her, and she looks like she's 30 years old, and she says to the client, you're going to have to pay generations giving tax as well as gift tax. He says, no, she's really 60. I mean, on its face, it's preposterous. You can't accept that kind of information. You can't accept, for example, well, I'm doing this for a profit motive. You can't just accept things at face value if they do not appear to be reasonable on their face. Now, here's the big one. This is critically important. Every time you give advice to a client, you have to tell that client of all penalties reasonably likely to apply. Now, what's reasonably likely to apply? Maybe there's 1 chance in 10. So when you're sitting there, I know you are not abusive down here like my colleagues are in New York. My colleagues in New York, believe it or not, tell people to create something called a family limited partnership and put assets in it and then take the position that there's a discount in value. I know it's shameful, but they do it. But let's suppose you wound up representing a client down in Florida. He dies. He was 90 when he came down. He wanted to get his handicap down, and he dies, and he has a family partnership. So you go to one of the appraisal firms and say, what are his limited partnerships worth? And they tell you it's 37% or whatever. And we get a lot of questions about what kind of duty do you have to look to see if that's reasonable. But you don't report the underlying assets from the partnership directly on the return. Now, the IRS is batting a little bit better than 500 in those cases, like Strange and Listrom that just was decided the other day, where they say the underlying assets themselves are includable in the estate. But you don't report those. If there's 1 chance in 10 that you should have reported them, well, did you tell the client that there could be a penalty? Now, by the way, I'm not going to go through it, but you have to know the penalties under Section 6662. You have to. It's not like that's really boring stuff. I hate this. You have to know them because you have an affirmative duty to tell your client about any penalty that might apply. 1 chance in 10. Now, by premise, your client has lost, and by premise, your client has been penalized, and then they come to you and they say, by the way, Diana, I don't remember you telling me about this possibility of a penalty. Now, what are you going to say? If you've lost the case, isn't it likely somebody will conclude there was at least 1 chance in 10 that a penalty could be imposed? So how do you defend that? So now you have a 3-front war you're fighting, worse than Adolf Hitler had. Number 1, the client's expecting you to pay the penalty, and she's going to sue your butt off if you don't voluntarily pay it. And now, by the way, when that happens, can you imagine going to your partners or the management of the firm and saying, gee, the client's upset, the penalty was imposed, she's expecting us to pay it. You're now fighting not just with your client, you're now fighting with the firm. And you're going to be off the case now, and someone else is going to represent that client. The other thing is when clients sue you, they do something else. They go to the Bar Association. And they say that she violated her duty to me. So now you've got to deal with the Florida Bar. And number 3, she's going to have her lawyer send a letter to the Office of Professional Responsibility of the IRS saying she committed a Circular 230 violation because she didn't advise me of the penalty reasonably likely to apply. And by the way, you also have to tell her of how she can avoid the penalty through disclosure. Now, by the way, I know nobody here knows about this, and I know no one of you have ever done this. This has been in the law for about 25 years. It didn't come down last week. But you've got to go ahead, and you've got to know this, and this is something you have to drill into the head of your colleagues.